So it was a few years back, and met with a prospective client. She was referred to me by one of my current clients. She worked at Disney, had been working at Disney for a long time, and really didn't put a lot of thought into her 401k investment allocation. She was working for Disney, and so she just thought, hey, I work for Disney. I think the company's a good company, so I'll just buy the company stock. Lo and behold, over a 35-year career, she ended up with a pretty significant amount of money in her 401k, and all of it was in Disney stock. And on top of that, she also participated in what was called the employee stock purchase plan, which in essence was available for people before the early 2000s when the company stopped offering that. But it was a way to buy the company stock outside of your 401k in an after tax account, and the company offered a benefit for that, a discount for that. And so she ended up having a ton of Disney stock to her name, which the company has done well over that time frame. She certainly has made money, but it got to the point. This was a few years ago, so the stock was got up to 150, $160 a share, or a little bit more than that. And so we were talking through the risks of having that much of your wealth tied into one stock. In this instance, it was the Disney stock, but this would really probably apply to any individual stock situation. And so she was really reluctant, though, because she has done so well in the stock. She wanted to continue to hold the stock and thinking that it would go higher. And after our conversation, it did go higher. But then a little bit further after that, it dropped pretty significantly. And it really has not recovered back to the point of where it was, although there has been kind of fits and starts of it trying. I mean, it almost dropped in half from its highest point, a little bit more than half from its highest point. And so the risks are real with any individual stock. The company can do great, and usually with individual stocks, you have the potential for great reward, but also there's great risk, meaning that you could, in essence, lose everything. Of course, don't wish anything on the Disney company, but you think about companies from the past that have gone completely bankrupt, Lehman Brothers or Blockbuster or Kodak or Toys R Us. I mean, there's all of these companies that no longer exist, and that can happen. And so that's a risk that we have to take into consideration. And so, if you have found yourself with too much Disney stock, whether that be your contributions through your 401k, or maybe you bought this employee stock purchase plan at some point in time, or maybe even you have bonus eligibility and you've been receiving bonuses in Disney stock, and you've just left it in Disney stock and haven't done anything with it over the years, and now you've got a pretty good chunk of stock there. There are a few things that you can do to manage the risk and to try to effectively mitigate some of the potential negatives with having too much Disney stock. So three things to think about. One, how much is enough, or how much is too much? The general rule of thumb is about 10% of your investable assets is really a towards a maximum amount that you want to have in any one stock investment. Now, you can have more than that in a fund. For example, if you invest into a large cap stock fund, maybe that fund probably has 400 or 500 or 1,000 different stocks within it, so you're diversified within that one investment. However, if you put more than 10% of your investments into one stock, that's one company, one business that has all of the risk of the general stock market, but also all of the risk tied to that one business, through leadership decisions, financial decisions, bad sales, competitors, all of that. So it increases the risk significantly by having too much in one stock. And so the general rule of thumb is about 10%. Of course, each person is going to have different risk tolerances and different financial situations, and so it's good to understand the full picture. But that's generally a good starting point, is around 10% of your investable assets. So the second thing is, okay, let's determine that you do have perhaps too much of the stock. So what can you do? Well, you can First, you can just sell the stock, and if it's within your 401k, there are no tax ramifications associated with that. Uh, it depends on how long you've held it and how close you are to retirement. There may be some benefit in holding on to some of the stock, maybe not selling all of it, but holding on to some of it. Especially if you don't have much assets outside of your 401k, because there's some special tax rules with the Disney stock and the 401k plan that can be beneficial once you retire, to be able to have some alternate sources of taxable income through that Disney stock. So within your 401k, though, if you want to sell the stock, you can sell the stock. There's no tax ramifications in selling the stock on the gains. If you hold the stock outside of the 401k, like either through LTIs that you've been bonused, or if you bought the stock along the way through your career, then there are some considerations of you could sell it, or you could use some options to protect the downside. There's basically a way to perhaps take the dividend and the interest from the dividend. You can buy what's called an option, which basically can give you some protection on the downside, so that if the stock does drop in value, you can give yourself a floor on how much losses that you would have related to any sort of drawdown. You could also just do something called a stop order, where basically you put in the number that you want to sell at. Let's say the share's at $115 right now, for example, and you wanted to, if it drops 10%, so roughly $100 a share is when you would want to sell. You wouldn't want to go any further. You can put in that order into your custodian, and then it will automatically sell at that point. Now, it doesn't guarantee you that price. It just basically automatically sells. And so it's a market. So there has to be a buyer that's willing to buy at that price on the other end. So there's some nuance there, but that's one way to mitigate the risk, is either through a stop order or through options. Options can be a scary word, but in essence, it basically just gives you the ability to give you some downside protection. In this instance, there's lots of complicated versions of that, but that's one way to do it. And then the third thing that you can do is looking at, you also can possibly use the stock for gifting. So if you go to church, or if you give money to your church, or you give money to charities or temple, or whatever charitable organizations you maybe want to support, you can gift some of your stock to them instead of writing them a check. And in essence, what that does is that gives them the full dollar amount. So let's say you're going to give $1,000 to your church. You can give them instead $1,000 of Disney stock. They sell it, realize the gains, but you still get the tax deduction for the full $1,000. Now, there's some limits on how much you can give in 1 year and still claim a deduction, so you want to be aware of those limits. But those are just a few options. If you do have too much stock, how do you diversify out in a tax efficient way, hopefully to be able to mitigate your risks. And at the end of the day, we do want to be tax efficient, but ultimately we don't want the taxes to be our sole decision in investment decisions, because yes, taxes, long-term capital gains can be upwards of a 20% tax. So so let's say, for example, you have $10,000 of Disney stock, you paid $5,000 for that, 20% tax would then you'd have to pay roughly $1,000 in taxes on selling $10,000 worth of Disney stock, if you only had a $5,000 what you paid for it. So there is a real cost there. However, as we talked about, the Disney stock could drop 40, 50, 60% or more possibly. And so then you end up not paying the tax, but you end up possibly at risk of losing more than what you would pay in tax. So we want to make sure that we're thinking about the investment strategy first, and then taxes second. But those are some ways that you maybe could use or think about when it comes to possibly diversifying out of Disney stock if you have too much Disney stock in your portfolio. My name is Kyle Newell. I own Newell Wealth Management here in Winter Garden, Florida. Meet with folks face to face around Central Florida area, or virtually across the country. If you have questions, feel free to drop a comment or shoot me a message, and I'd be happy to help. Please like and subscribe if you can. And I hope you found value in that, and hope you have a great day and take good care. Bye-bye.